Today, we're looking at Pro Medicus, ASX ticker PME. This is one of the highest quality businesses on the Australian market. In FY25, revenue reached $213 million. Underlying EBIT margin hit 74%, and the company finished the year with about $211 million in cash and investments, with no debt. So the big question is not really whether this is a good business. The real question is this: is the stock still too expensive?
Before we do though, quick disclaimer. Nothing in this video is financial advice. I'm not a licensed advisor. This is purely educational. Do your own research. Talk to a professional if you need to. All right, let's go.
Before we get into the bigger story, let's start with where the business sits right now. In the latest half-year result, Pro Medicus reported $171.2 million in net profit. But that number includes a very large unrealized gain from its 4D medical investment. If you strip that out, the underlying operating picture was still strong. Revenue was $124.8 million. Underlying profit before tax was $90.7 million. And underlying EBIT margin rose to 73%. So yes, the stock sold off hard after the result, but that was really the market repricing the multiple, not the core business falling apart. At a simple level, Pro Medicus sits inside the medical imaging workflow. A patient gets a scan. That image needs to be loaded, viewed, interpreted, and turned into a report. Pro Medicus helps hospitals do that through its Visage platform. And the reason investors care is simple. PME gets paid as those scans are viewed and processed. So this is not some vague software story. It is a real product used in real hospitals solving a real workflow problem. And the company itself goes back a long way. Pro Medicus was founded in 1983, listed on the ASX in 2000, and the Visage acquisition in 2009 was the move that changed the business. The product story is actually pretty easy to understand. First, it is built for speed. Large imaging files can be handled much more smoothly than with older systems. Second, that speed matters because radiologists are overloaded. Anything that helps them get through cases more efficiently has real value. And third, this is not a niche tool used by tiny clinics. Pro Medicus says it now services 11 of the top 20 U.S. hospitals. That tells you this platform is already trusted by some of the most demanding customers in the world. This is where the investment case gets really interesting. A lot of healthcare software companies rely on upfront licenses, big implementation projects, and hardware-heavy rollouts. Pro Medicus is different. Its model is largely transaction-based. In plain English, that means the company earns more as usage grows. So once a hospital is live, Pro Medicus does not need to keep reselling the same deal again and again just to grow. That is a big reason margins have become so strong. In FY25, underlying EBIT margin reached 74%. That is an extraordinary number for a software business.
When you look at this chart, the first thing that stands out is just how strong the growth has been. This has not been one lucky contract, and it has not been one flashy year. Revenue has kept climbing, while the company stayed profitable and disciplined. For beginners, this is one of the easiest signs of a quality business. Growth that looks steady and repeatable, not random and messy. This chart is one of the most important ones in the whole video. What it shows is that as revenue rises, profit is rising even faster. That is what investors mean when they talk about operating leverage. In a business like this, once the product is built and the customer is live, the extra cost of serving more volume is relatively low, so more of each extra dollar can fall through to profit. That is a big reason Pro Medicus has been able to lift underlying EBIT margin from roughly the low 60s a few years ago to 74% in FY25. This chart tells a similar story from another angle. Earnings per share have risen strongly, and returns on capital have stayed very high. That matters because it suggests this is not just a company getting bigger, it is a company getting bigger without needing huge amounts of extra capital to do it. That is exactly the kind of business model long-term investors tend to love. Here is another quality check. Some businesses look great on paper, but the cash never really shows up. That does not look like the case here. Pro Medicus has remained a very capital-light business with strong cash generation and very little need for heavy reinvestment just to stand still. That is a big part of why the balance sheet looks so strong. Now let's talk about the moat. The first part is switching costs. Once a major hospital has built a platform like this into its workflow, replacing it is not easy. It's disruptive, time-consuming, and risky. The second part is reputation and validation. When 11 of the top 20 U.S. hospitals are using your platform, that gives you credibility in every future tender. And the third part is the technology itself. Management argues that Visage was built differently from the start, and that its cloud-based design still gives it an edge in speed and workflow integration.
So, is there still room to grow? I think the answer is yes. This is still a very large market, and Pro Medicus is still mainly talking about growth in North America, plus expansion into adjacent areas like cardiology and pathology. The key point for beginners is this: a company does not need to own the whole market to be a great investment. It just needs a product strong enough to keep taking a little more share over time. This is another big part of the story. Management said total minimum contracted volume for the next 5 years has climbed to over $1 billion AUD. That gives the business a meaningful base of future revenue before you even start talking about completely new wins. And the story is still moving. On 8 April 2026, Pro Medicus announced a new 5-year, $23 million AUD contract with the University of Maryland Medical System. The platform is being implemented in the cloud. So even before you speculate about blue sky upside, there is already a substantial contracted base sitting underneath the business. This slide needs to be explained carefully, because AI is where people often overreact. The simple version is this: AI does not automatically kill the value of Pro Medicus. Management's view is more or less the opposite. Their argument is that Visage sits inside the imaging workflow, and that makes it a natural place to connect AI tools into real clinical use. So for PME, AI may end up being more of a revenue layer than a disruption story. Not guaranteed, but clearly a real option. This one is refreshingly simple. The company remains debt-free. At the end of FY25, it had about $210.7 million in cash and investments. By the latest half-year result, that had risen to $221.8 million in cash and other financial assets. That gives the business flexibility, and it also means Pro Medicus is not being forced into risky deals or emergency capital raisings just to keep the story alive. Now we get to the uncomfortable part. This is still an expensive stock. The old line that PME was on around 100 times forward earnings now looks stale. On the latest Yahoo Finance snapshot I checked, the forward PE was about 64.1 times. That is well below the old peak multiple, but it is still premium pricing. So the updated message is not valuation does not matter now. The message is valuation still matters a lot, just not in the same extreme way as before.
Founder-led businesses can be powerful, and Pro Medicus is still very much founder-led. Based on the latest holder data I checked, Anthony Hall owns about 23.1% of the company, and Sam Hubert owns about 23.1% as well. So together, they still control roughly 46%. That alignment is a positive. The trade-off is obvious too. When founders matter this much, key person risk becomes part of the story. Another point in PME's favor is that this is not a business that burns cash and asks shareholders for patience forever. It has paid growing dividends, and it has also bought back some stock. That tells you the cash generation is real, and that management has enough confidence in the business to return capital while still funding growth. There are 3 real risks here. The first is still valuation. Even after the pullback, the stock still trades on a premium multiple, so the market can be unforgiving if growth slows. The second is competition. Pro Medicus is strong, but it is not alone. Strong products still need to keep winning contracts. And the third is execution at larger scale. As the company moves further into bigger health systems and more adjacent products, it has to prove it can keep growth strong without weakening pricing or service quality. So, here is the balanced view. The bull case is that this is an exceptional business. High margins, strong cash generation, founder alignment, a sticky product, and a very large contracted base. The bear case is that a lot of that quality is already known, already admired, and still partly priced in. That is why PME is such an interesting stock. Nobody really argues much about whether the business is good. The argument is about how much you should pay for something this good. If I step back and score the business category by category, Pro Medicus looks very strong on growth, quality, moat, and balance sheet. The weaker part of the scorecard is still valuation. So this is not really a debate about business quality versus business weakness. It's a debate about business quality versus market expectations. So what should investors watch from here? First, the FY26 full-year result. Is revenue still moving the right way? Are margins still staying above that 70% area? And is underlying profit growth still strong? Second, watch cardiology, pathology, and broader product expansion. These matter because they could extend the runway beyond the core radiology story. And third, watch for new contract wins and implementations. The new $23 million UMMS contract is a reminder that the sales engine is still active. So that's really the PME story right now, a genuinely outstanding business, a stock that's cheaper than it was, but still not cheap, and a company that still has a lot to prove. Not because the product is weak, but because the market has set a very high bar. That's it for this one. Thanks for watching.